What's up everyone, it's Scotty with Money Investing. So in this video, I wanted to talk a little bit about Ray Dalio's recent paper on LinkedIn, which kind of seems a little bit like a warning, but definitely wanted to go over a synopsis, a summary of what he discussed. I highly recommend everyone to go read it themselves. It's publicly available on LinkedIn. He posted it I think yesterday or earlier today. So there's a lot of insight into the fiscal policy and of course a little bit of monetary policy as well, going over some charts and where we're coming from and where we're potentially headed. Now, when it comes to where we're potentially headed, Ray Dalio does talk about that it's a very difficult to kind of aggregate all that information, all these different variables, because, as we have talked about, macroeconomics is such a vast discipline that you can't basically look at just one data point. There's hundreds of millions of data points to look at, and we have to look at it from a more granular scale and then add them together to connect the dots to better understand what is most likely to happen. Again, it's a probabilities game. There's no certainties, there's no guarantees in the world of investing, macroeconomics, finance, and trading. So hope you guys enjoy this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below. We'd love to have you on board. It's the first week of the month, usually the best time to join, so you get access to all the binds alerts, options alerts, trade ideas, the intrinsic value spreadsheets, the members only private videos. There's a lot of benefits included, so links are going to be down below. We'd love to have you on board. This right here is the research posted by Ray Dalio. What's happening with the economy, the great wealth transfer. Now, to give you a little bit of a summary of what that great wealth transfer is, what he's talking about is that during the COVID times, when interest rates were literally down to 0%, the monetary policy, Jerome Powell, the Federal Reserve, basically cut rates. What happened back then was, and of course with all the stimulus checks and employment benefits given out to the people, to businesses, what really happened was that right now we've got the private sector, which is households and businesses, in a far better shape, much better shape than the public sector, which is the government, right? Fiscal monetary policy and their balance sheets. And the main reason for that happening is because of rates down to 0%, all the government stimulus pumped into the economy, given out to households, given out to businesses. And that's why the great wealth transfer happened from the public sector over to the private sector. And a great indicator for that is the fact that the economy continues to be incredibly strong, right? Even though the rates are so high, the Federal Reserve's been raising rates over 525 basis points in the last 12 months, 18 months, the economy continues to be strong. Why? Because the balance sheets for households and businesses are far better than the balance sheets of fiscal policy, monetary policy, the Treasury Department, and of course, when it comes to central bank's balance sheet as well, which is the Federal Reserve. So that's the great wealth transfer. But this right here is another really interesting question that he asks us, basically asking, does it matter that the central governments and central banks have such bad balance sheets and income statements if the real economy is in pretty good shape? By real economy, he means, again, the private sector, the businesses, the households. He says, of course it does. As with people and companies, governments that borrow have debt service payments, so they need to continue to pay the interest on their debt to service that debt, and eventually have to pay back the principal, which is painful. The only difference in their finances are the governments can confiscate wealth through taxes, so they can tax people more, as we talked about in one of my other videos. The government basically makes money one way, by taxing people. Their tax revenue comes in, and of course they control spending by, again, all the budgets that they have, and of course potentially lowering the standard of living. But they can also generate more money by printing money, right? So that's two ways, right? So they can basically tax people, so that's tax revenue coming in, or they can print more money via the central bank. So that is what we should expect to happen. Now, will this be a big problem? He says the answer is probably not much over the near term, but probably a lot later. And that's that's kind of like the consensus, and something that I've also shared personally is that one of the biggest risks that I see for the US is this unsustainable path of the debt, right? The debt limits and the mountain of debt, the fiscal deficits every single year. That's a big problem, right? And eventually we're just kind of kicking the can down the road. Eventually we have to face the reality. We have to rip the band-aid. And again, that when the time comes, we'll face it together. But, Ray Dalio pretty much says not going to be an issue in the short term, maybe in the near term, but it could be probably a lot bigger problem later. And that is for the reasons that he will explain briefly and more comprehensively in a later writing. But this right here is, again, going over some looking ahead sort of analysis. He says over the near term, if there isn't a big supply-demand imbalance in which the amount of government debt sold overwhelms the amount of demand for these debt assets, as it appears that the period of tolerably slow growth and tolerably high inflation is most likely. So what does he mean by that? So remember we talked about how there is obviously a debt ceiling, right, for the Federal Reserve, for the fiscal policy, the Treasury Department. And that debt ceiling obviously was going on for a long time, back in, I believe, March, April, June. And then that got suspended and raised, I think, until 2025, at the end of early 2025, end of 2024. But the bottom line is the Federal Reserve obviously is shrinking their balance sheet right now. And the Treasury Department is raising more capital, right? Because they need to continue to spend money, right? And they obviously run a fiscal deficit every single year. Now, in order to raise capital, what do? They basically sell government bonds, right? So they do all these auctions, the 10-year, 20-year, 30-year, 5-year, 3-year, whatever these auctions, whatever these bonds are. They sell them to the public, to foreign governments, to investors, whoever wants to buy. Now, if there's a lot of supply that's coming in, right, because I'm actually going to be doing another video later. We'll talk about how much we're doing, like record issuances of these government debt, right? We'll talk about that in another video. This is very important. But as the government keeps on selling these bonds, if the demand isn't as strong and the supply continues to overwhelm the demand, what happens, right? Prices continue to drop. And that's exactly what we're seeing. Recently, we've seen the yields once again go higher, right? The 10 years back over 4.1, the 20 years back over 4, 30 years back over certain levels, and of course short term, the shorter duration of those bonds also pushing higher. So that's what happens. There's a higher interest rate, higher coupon rate for these bonds, which means a higher payment for the Treasury Department against their debt. That means they have to pay more in interest every single year if the rates are higher. So that's exactly what he's talking about. He says over the near term, if there isn't a big supply-demand imbalance in which the amount of government debt sold overwhelms the amount of demand for these debt assets, it appears that a period of tolerably, like we can tolerate it, slow growth and reasonably high inflation, a mild stagflation is most likely. Of course, there is a significant range of uncertainty around that because we don't know is greater than what we do know about a lot of influences. However, he says, okay, now this is important, over the long term, from looking at history and penciling out what is likely, it is virtually certain that the central government's deficits will be large, and it is high probable that they will grow at an increasing rate as the increasing debt service costs plus increasing other budget costs compound upward, and as they increase, governments will need to sell more debt, so there will be a self-reinforcing debt spiral. That's a really, really bad. I don't think people understand how bad that situation will be, because what Ray Dalio is talking about here is if there is no solution to this problem, rates can continue to go high, which will be a higher debt service cost. So the cost of that debt will go up, which is interest. And coupled with that budget deficit, you combine those two, and that will be upward spiral of debt constantly going higher. And in order for what? In order for the Treasury Department to finance all that debt, what are they going to do? Once again, they're going to sell more debt to raise more money to finance the old debt. And that is that spiral that he's talking about, which could obviously lead to a market-imposed debt limits, while central banks will be forced to print more money and buy more debt as they experience losses and deteriorating balance sheets. So those are some things that, obviously that we have to be aware of. While central banks have had significant losses, they have not yet been to a point of these losses affecting monetary policy, but it is not inconceivable that they will follow the classic late big cycle dynamic, which is also consistent with not unreasonable projections that are deeply concerning as to what might happen. I feel like the words don't do enough justice to the severity of the problem that we have or are facing with respect to the debt levels in the US, and something that obviously is concerning for me. And this is going to be a constant topic of conversation. So, over here, obviously he's talking about a little bit of that income, spending, employment compensation. So during COVID, obviously, what did we see? We saw the income levels increase. So that's the blue line, right? Huge spike because of all these stimulus checks. Spending dropped because people were working from home. People were literally at home. They weren't going out and spending money. So when you've got income going up, savings going down, what happens to the savings rate? You're pretty much saving almost all of it, right? So this is the huge spike in savings rate. But then, of course, when the economy reopened, now you've got spending obviously much higher than income. People are spending more money than they are generating an income, and that's why the savings rate's back below 5%. People are not saving as much. This right here is going to be that unemployment rate. Again, the private sector continues to be very strong. Businesses, households, they still have debt that is fixed and locked at sub 2%, 1.5%. So as a result, they've got good balance sheets. Economy continues to be strong, even though rates are higher. So for those reasons, it does look like, again, the economy is very, very strong. This right here, fiscal deficit, continues to be large. Fed bond holdings as a percent of GDP, they have been coming down because they've been rolling over their balance sheet, which is good. That's, solving a little bit of that problem. But of course, from a fiscal standpoint, we still have a long way to go as the US government debt outstanding, of course, approaching $32 trillion and a percentage of GDP a little bit over 122%. At the moment, that's expected to eclipse over 200% by 2050 as well. So let me know in the comment section down below. What do you think about this? I know it is not great news or not great sort of optimistic video, but it is a reality video, right? It is something that we have to understand. And, if we keep ignoring this, if we keep kind of like putting a blind eye to this, then eventually it's gonna blindside us, right? So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord, Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.